The silver does not go past $100, top that we saw above $100. Silver is in a supply deficit. Mined silver is insufficient to meet the industrial demand for electronics, solar panels, automotive, military, and things like that. Going forwards, the bull market story for silver is intact, but we're going to have this period of ups and downs. Going forwards, the bull market story for silver is intact, but we're going to have this period of ups and downs. So coming back to gold, like we've seen with silver, we had this huge spike up to 5,500 nearly, and we're now nearly $1,000 below that. So the desire of central banks to have more gold in their reserves, and it's a desire, they can't always do it, but it's a desire to hold more gold. Part of that will be accomplished through a higher gold price, and part of it will be accomplished by buying physical gold and putting it into their reserves. That's not going to go away, and investor demand is most definitely there. You know, any wobble in the stock market will have people thinking, shouldn't I have gold in my portfolio?
Silver, because last time I had you on the show was early December of last year, and you said a violent move could be coming in silver, and you definitely were proven correct. As silver then, the time of the recording, it was $58. It then surged to a close of $116 approximately, new all-time high, before collapsing down to $70 and has largely churned sideways since then. We're at about $73 as of the time of this recording. Was that the peak of silver's bull run, or do you think there's more upside ahead?
Well, first of all, it shot up a lot faster and further than I actually expected at the time. And needless to say, there were a lot of people who came in much later after our podcast. I think that where was the price? It was late, early 60s.
$58 approximately.
Yeah, so it was 58. And it shot up very quickly above 100. A lot of people came in at above 100 and now are wondering if they made a mistake. So the answer to your question, was that the blow-off top? No, I don't think so. In every bull market, we will have this type of surge followed by a pullback, and the pullbacks can last many months. They can last 7 months. For example, I'm just giving you an illustration. It could be longer, could be shorter. But silver is in a supply deficit. That is to say, mined silver is insufficient to meet the industrial demand for electronics, solar panels, automotive, military, and things like that.
Markets celebrated a 100% silver rally, but ignored the 40% collapse that followed. And that blind spot is where portfolios get hurt. Volatility. This extreme historically clusters in mid-cycle, not at tops. Yet Clive Thompson's analysis suggests the real story isn't price. It's structural shortage masked by paper selling. Retail chased above $100 while institutions faded into liquidity. A classic distribution pattern. For investors, this means months of chop before a decisive move resets positioning. Next, Clive Thompson reveals why that supply deficit narrative quietly contradicts COMEX behavior.
So the way when you have a supply-demand imbalance is you have to use above ground stocks. And the way it will work in silver's case is higher prices. So that's a lot of silver users towards the end of January or after December were starting to accumulate silver with a worry they may not be able to get their hands on it. So they started to buy silver rapidly. And as the price rose, they became more and more concerned about the supplies. So instead of having a just-in-time supply, silver consumers, that's industrial companies, started to buy silver to have several weeks' supply or even a month's supply. That's part of the reason why the price was driven up so rapidly. But of course, when the subsequent collapse came, the worries about being able to lay their hands on silver diminished. So we could be in for a long period of many months where the silver does not go past $100. But I think that, and this is not investment advice, I think that top that we saw above $100 will be surpassed again, because that supply-demand deficit is not going to go away. We're not going to start using less electronics than before. The growth in the use of silver in the electronics industry is only growing as things become smaller. The smaller it is, the more reliable you need your connections to be. You don't want to use a secondary metal like copper for microelectronics. I think that going forwards, the bull market story for silver is intact, but we're going to have this period of ups and downs.
This exact inventory hoarding pattern showed up 6 months before the 2011 silver peak, and again before the 2020 breakout. Industrial buyers shifted from just-in-time to stockpiling, a timing signal Clive Thompson highlights as demand panic, not steady growth. But here's the contradiction. Prices collapsed even as physical fear peaked, suggesting paper markets overwhelmed real demand. That divergence creates a dangerous lag where retail reacts late. For investors, this means extended consolidation before the next supply squeeze becomes undeniable. Next, Clive Thompson exposes why industrial demand spikes often precede violent corrections first.
And you can be using this current data. We're at a down today, although I see it's up 2.5% today. But by the time you watch this, it might be down. But forget the intraday fluctuations. This is a period when you can be acquiring slowly but surely a little bit every month, and you'll get an average price. If you buy every month, you're sure you haven't paid the highest price ever. But you're not going to get the lowest price ever. But the people who are sitting on their hands waiting for the lowest price ever probably won't get filled.
Yeah, I think that's some great words of wisdom, because a lot of people try to time the market. They think they know intuitively when things are going to go up or down. Usually in the long run, that doesn't work out, although you can get lucky in the short term. I totally agree with your view on focusing on the fundamentals and the long-term story. What do you make of China restricting silver exports from the start of this year and importing record amounts of silver in March, as reported by Bloomberg? Do you think this is a strategic move on their end? And do you think they're stockpiling silver for industrial purposes, monetary purposes, or both?
Well, China's move to restrict or rather control silver exports is reflecting a broader push towards resource security for China itself. They want to make sure that they can get their hands on that resource if and when they need it. Hence the fact that companies who will export, and only a few can export, will need permission.
China just restricted exports while importing record silver. And that's not a market signal, it's a policy signal. Export controls historically precede domestic shortages. And Clive Thompson points to this as resource nationalism quietly accelerating. But here's what's not being said. When governments intervene, price discovery breaks and global supply tightens unevenly. Institutions see this early and reposition before headlines catch up. For investors, this creates asymmetric risk. Availability disappears before price reflects it. Next, Clive Thompson reveals what China's import surge suggests about future monetary positioning, not just industrial demand.
So it's serving, from China's point of view, both as ensuring that the industrial needs can be met, but also it's serving as a kind of monetary hedging. The more silver they've got, the less they need to hold other currencies like dollar. And we're in a world where we all know that every currency on the planet to some extent is being debased, particularly I don't want to say particularly the dollar, because the dollar is in the middle of the bunch. But we know that the currency is being debased. So why wouldn't you hold a precious metal, something which is in the long run going to hold its value and obviously appear to have risen in value because the price or the value of money is going down? So basically it's both. They're protecting themselves to make sure they've got it when they need it for industrial use, and while they're waiting, they're using it as a sort of monetary alternative.
Very interesting. How are you currently viewing the gold market? Because obviously we saw new all-time highs this year. Gold and silver have pretty much performed in tandem, of course, gold being the less volatile metal, but moving in the same direction. Do you view the two metals as inextricably linked? And what is the case for gold in a portfolio today versus silver?
So gold is purely a monetary asset and a wealth preserver. Silver is both industrial and monetary. And of course, if we go back in time to before the 1930s, silver was part of the coinage in every country. It had an intrinsic value because it was a rare metal. So it's every bit a monetary resource. Now,
central banks claim confidence in fiat, yet quietly accumulate metals that compete with it. And that contradiction is widening. Global M2 has surged while real rates remain unstable. And what Clive Thompson is signaling here is a silent shift toward hard assets as currency hedges. The narrative says diversification, but the behavior shows distrust. When sovereign players treat silver as both industrial input and monetary reserve, price signals get distorted. For investors, this means official narratives lag reality by years. Next, Clive Thompson unravels why gold and silver moving together hides a deeper structural divergence.
If we go back in history, the gold to silver ratio was much lower than it is today. That means to say you needed less silver than you do today to buy an ounce of gold. What that implies is that, let's assume that gold it's not going to go down much. I mean, a possibility of below 4,000 is possible, but I don't think it's going to go anywhere back to the figures we saw a couple of years ago. So that basically implies that if silver was to go back to its old ratios, the silver price has to rise a lot to get to the old ratios, even if gold stands still. And I don't think gold will stand still. So coming back to gold, like we've seen with silver, we had this huge spike up to 5,500 nearly, and we're now nearly $1,000 below that. So it will take time of ups and downs before it goes past the all-time high. I think there's a good chance we will do that this year, but I don't think it's going to be a straight line. It's definitely going to be we're going to have days where people are going to say, "Oh, Clive Thompson, who was recommending gold, look at it's down today." And then 6 months later, I thank God I followed Clive because it went up. Now, I'm not making investment advice. I'm just telling you what I think. But we're in a world where the confidence in international currencies is declining.
If this ratio distortion persists another 6 to 9 months, portfolios overweight gold, but underweight silver risk missing the real revaluation trade. The gold-silver ratio remains historically elevated above long-term averages, and Clive Thompson highlights that mean reversion alone implies disproportionate upside in silver even if gold stalls. But here's the disconnect. Investors chase stability in gold while ignoring the leverage embedded in silver's catch-up phase. For holders, this creates a silent opportunity cost that compounds over time. Next, Clive Thompson reveals why ratio compression cycles often begin when confidence in currencies quietly breaks.
The desire of central banks to have more gold in their reserves is, and it's a desire, they can't always do it, but it's a desire to hold more gold is there. Part of that will be accomplished through a higher gold price, and part of it will be accomplished by buying physical gold and putting it into their reserves. That's not going to go away, and investor demand is most definitely there. You know, any wobble in the stock market will have people thinking, shouldn't I have gold in my portfolio? I mean, mathematically, it's not been proven, it's been known, but it's proven that if you had gold in your portfolio over the last 5 or 10 years, it would have reduced your portfolio volatility, and depending on when you bought it, but at most time, almost every time, would have increased your return. So from a portfolio asset allocation point of view, it makes sense. Now, many funds cannot buy gold because that's not their mandate. The mandate is to hold equities or a 60-40 portfolio. But there's plenty of money out there which could buy gold. And I think it's only a question of time before gold starts to creep back into portfolios a bit more. We've already got quite a number of investment banks bringing out bullish forecasts for gold. But to what extent it's actually finding its way into the portfolios, it's a very slow process. It's nowhere near the 5%, which was traditional when I came to Switzerland in 1985. I'm guessing it's 1 to 2%, maybe even less than 1% at the moment. But in my opinion, there's a long way for it to go in terms of portfolio allocation.
Institutional portfolios still hold under 2% gold, despite decades of evidence it reduces volatility. And that gap is where the next move builds. Central bank purchases have quietly accelerated while public mandates lag. And what Clive Thompson is signaling here is a structural under-allocation across global funds. The narrative says diversification is priced in, but positioning data suggests the opposite. When mandates eventually adjust, flows won't trickle, they surge. For investors, that transition window defines the next cycle of returns. Next, Clive Thompson exposes why institutional buying happens before portfolio models officially change.
And I would use this period of relatively low prices for those who want to stack physical gold to go along to the coin shops and see what they can buy.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Well, let's dive into the war in Iran and its implications for the global economy, because every day Trump seems to say something about the war coming to an end in a peaceful manner, and the next moment he's threatening to destroy the whole country. It's been absolutely wild to see, but if we can home in on the investment implications here, how do you see this conflict affecting precious metals, energy, and broader financial markets?
Well, to tell the truth, I've never seen any evidence that in the short run, a war pushes up gold. Now, of course, that could have been the case in earlier years, but then we were on a fixed gold standard, so it didn't make any difference. So I've not really seen evidence. I mean, let's take as an example the Russian invasion of Ukraine. Gold went down when that happened. I think it was about 1800. It went down to around 1600, something like that, and stayed down for more than 6 months before it took off.
Geopolitical tension spikes, yet gold often drops first, and that breaks the safe haven narrative investors rely on. Historical data shows gold fell nearly 10% after major conflict triggers before recovering. And Clive Thompson points out this counterintuitive reaction is consistent, not anomalous. The story says fear drives gold immediately, but liquidity demand drives dollars first. That lag creates a trap where investors buy the wrong moment. For portfolios, timing matters more than direction in crisis cycles. Next, Clive Thompson unravels why currency demand, not war itself, ultimately drives gold's real moves.
So in my opinion, people, when there's a war, yes, they do respond to uncertainty, but the natural reaction in the early stages is to rush into things like the US dollar, rush into other assets first, and gold is more of a second thought as things become, as the war becomes normalized or it starts to fade away. So I think gold is not responding to wars because people don't feel the need to have it in their pockets to run away from an invasion. You know, people rather would like to hold dollars. If they're running away from an invasion today, they'd like to hold dollars. But what they do react to, and this is the alternative, they react to a distrust in the currency. So as we print dollars to finance a war, that creates a greater supply of dollars or whatever currency is being printed. And we're in a printing spree around the world. We've seen the central bank expand the money supply. M2 money supply is rising rapidly in the last year or two. We've seen government debts, not because of the war, but generally rising rapidly. But of course, increased military spending, which we're seeing in Europe and the USA and everywhere else on the planet, increased military spending means that government debt has to increase. And as government debt increases, the confidence of people to hold it reduces. So I think we'll get to a situation where people will, not because of the war, but because the government debt is increasing, because the amount of money on the planet is increasing, they'll start to say, I need to have an allocation to something which is going to hold its value and protect me against whatever's coming with the currency.
The dollar rallies during war, but the damage to purchasing power begins at the same time. And that's the contradiction most investors miss. M2 money supply has expanded aggressively alongside rising debt, and Clive Thompson's analysis suggests gold responds not to conflict, but to currency dilution that follows. The narrative frames gold as a fear trade, yet the real driver is trust erosion in fiat systems. For investors, that means the biggest moves come after the headlines fade.